Hi students, welcome to the video on financial accounting, admission of a new partner. This is the third video based on partnership account. So in case of admission of a new partner, the old partner has to revalue the assets and liability of the firm. In case there is increase in the value of assets in comparison to liability, then there arises profits. Then that profit will be distributed between the old or existing partner in their old profit sharing ratio. Then they will calculate the sacrificing ratio based on their old ratio and new ratio after admission of a new partner. That new partner had to bring his share of goodwill, that is premium for goodwill, to the business, and that amount will be distributed by the old partner in their sacrificing ratio. So sacrificing ratio is old ratio minus new share. That is the old profit sharing ratio of old partners or existing partner minus new profit sharing ratio with the addition of a new partner. That is sacrificing ratio, and they will share the premium for goodwill in that sacrificing ratio. That means their capital will be credited. Then if they want to withdraw, they can withdraw the money, debiting their capital to cash. Here one problem is given, we have to solve it. X, Y are partners in a firm sharing profit and losses in the ratio of 3:1. That means X was getting 3/4 share of profit and Y 1/4 share. Their balance sheet as on 31st March 2023 is given below. Then under capital accounts, X capital was 30,000, Y's opening capital 20,000, total 50,000. Then one profit loss account is 10,000, that is known as undistributed profit. Whatever undistributed profit, that will be shared among the partner in their old profit share ratio. If there is undistributed loss on asset side, it will also be adjusted from the capital of the old partners. Then 100 hectare 40,000, under fixed asset land and building 28,000, furniture 5,000, then current asset cash 30,000, 100 or 15,000, stock 35,000. So the balance sheet total assets is equal to liability capital 1 lakh. Because the accounting equation tells assets is equal to liability plus capital. So Z was admitted with the following terms. Value of stock increased to 40,000. So we have to remember the formula. Increase in assets should be debited and decrease in assets should be credited, and reverse is the case in case of liability. Increase in liability should be credited, decrease in liability should be debited. Here the stock value increased to 40,000. Previously or originally our book value was 38,000. Then it is 40,000, 5,000 increase. So we will debit the stock for 5,000 and credit revaluation account. Then land and building reduced by 25,000. Original cost was 25,000, that means book value 28,000 into 25% means 6250 will be reduction in the value of land and building. So decrease in assets should be credited, will debit the revaluation account, credit land and building with 6,250. Again furniture decreased by 10%, that is 500. So revaluation account debited to furniture also 500. Then another is provision for bad and doubtful debt. Here sundry debtor was 15,000, on that 5% is 750. So that is also reduction in the value of asset. So revaluation account debited to provision for bad and doubtful debt. So under revaluation account, first journal entry is stock account debited 5,000 to revaluation account, being increase in the value of asset debited to particular asset account. Then that is reduction in the value of some assets. So revaluation account is debited. Total is 7,500. So we write 7,500 to land and building account, that is 6250, to furniture 500, to provision for bad and doubtful debt. Provision for bad and doubtful debt, that is also 750. So total comes to 7,500, being decrease in the value of assets credited to revaluation account. Then here in the revaluation, the credit is 5,000, debit is 7,500. So this is loss from revaluation. It will be adjusted from capital account of old partner in the old profit and ratio, that is 3:1. So we will debit X capital account with its share of loss, that is 3/4 into 2,500. This is 625. So debit is X capital debited 1875, then 625. Y capital debited 625. Y capital account debited 625 to revaluation account. Revaluation account. So revaluation account will be closed. Revaluation account, that will be closed in this account. Correct. That is 2500. Then next, one unrestricted profit of 10,000 there, profit loss. It is credit balance. We have to close by debiting that, and we will credit to the capital account of partner in their old profit sharing ratio. So before the admission of the new partner, whatever unrestricted profit, that will be taken by the old partner in their old profit sharing ratio. So here profit and loss account debited 10,000 to X capital account, 3/4 of 10,000 is 7,500. To Vice capital account 2,500, being amount of unrestricted profit distributed between the partners in their old profit sharing ratio, that is 3:1. Then the partner is bringing goodwill 15,000. If he is bringing cash account debited, or in terms of check, bank account debited. So cash or bank account debited 15,000 to premium for goodwill account, or only we can write also goodwill account. Premium for goodwill account, that is 15,000, being goodwill brought in by new partner, being premium for goodwill brought by new partner. Then that goodwill will be closed by transferring to the capital account of the partner in that sacrificing ratio. So journal this premium for goodwill debited, that is 15,000 to X capital account to Y capital account. On the air, that is sacrificing ratio. Here sacrificing ratio is equivalent to the old ratio, that is 3:1. Sacrificing ratio. So that also we can calculate. That is 15,000 into 3/4. 3750 into 3, 0, 5, 11,250, here it is 3,750. So we can calculate the sacrificing ratio. That sacrificing ratio will calculate for X, that is new profit, the first new profit sharing ratio. Here new partner is admitted for 1/5, 20% of future profits of the firm. That is 20%, Z will get 20% of profit. That is 20 by 100 into 1. That it is let the profit 1/5. Then remaining is 1 minus remaining profit 1, total is 1. Then Z has taken 1 by 5, so it is 4 by 5. So X new share will be, previously was getting 3/4, so 3/4 of 4 by 5, that is 3 by 5. And Y's new share will be, he was getting 1 by 4 into 4 by 5, that is 1 by 5. So their sacrificing ratio is equivalent to the old ratio, that is 3:1, and new profit ratio is 3:1:1. This is all about the sharing. So the premium for goodwill of 15,000 is distributed between old partner XY in their sacrificing ratio, that is equivalent to their old ratio, 3:1. Then we have to prepare the capital account of partners and Z. It is clearly written, Z will get 20% future profits of the firm. He was also to bring capital equal to 1/4 of the combined adjusted capital of X and Y. After preparing the capital account, we can know what is the combined capital, adjusted capital of X and Y, and based on that, 1/4 will be brought by new partner to the business. So we will prepare one capital accounts. Under capital accounts, left hand side is debit side, so we'll write D here. Right hand side is credit side, write C here. So here we'll write particulars. Then here X, Y, Z. Here also particulars X, Y, Z. So we will write the opening capital of X and Y, which is credit balance, write by balance brought down. So it is 30,000 and Y 20,000. Then second will post loss on revaluation. X account debited, Y account debited to revaluation account. So we'll write debit side to revaluation account, that is loss. X will be a 1875 and Y will be a 625 on loss on revaluation. Then undistributed profit, profit and loss account debited to XY, XY credited by profit and loss, that is undistributed profit distributed. X will get 7,500, Y will get 2,500. Then the new partner will bring his share of goodwill, that is premium for goodwill 15,000, cash or bank to premium for goodwill. Then premium for goodwill account, because here it is credited, debited, cancelled, ultimately cash or bank account debited to X or Y. We can write also by cash hyphen share of goodwill or premium for goodwill. So X account is credited for 11,250 and Y account is credited for 3750. Then we have to calculate the adjusted capital of the newly constituted firm. Here we will total the credit side, which is heavier. So credit side total is 05784. Here it is 508250. Then here we will arrive the closing balance by balance carried down, that is closing capital of X and Y. So total will be 48,750. So difference amount is 46,875. Here it is 8250. So 5, then 2, 6, 7. So total is 46,875. $875 plus 7625. 30,007, 48,000. Here also 20,000, not 8,000. Here it is. That is 20,000. So 20,000 plus 2,500 plus 3750. So total should be 50 to 26,650. 26,250. So it is 26,250 minus 26,250 minus 625. So it is 25, then 25. This is so 25, 625. So adjusted capital of X and Y is 72,500. That is adjusted capital, and 1/4 will be brought by new partner Z. So 18,125 will be brought by him. So write by cash. How much? 18,125. Here balance is 18,125. So it is 18,125. We will close the capital account of Partnor. Here we closed. Now we want to know what is the cash in hand of the business. So for that we will prepare one cash and bank account. So on cash and bank account, so cash at bank account. So opening balance was 20,000. So write 2 balance brought down, that is 20,000. Then he has brought the share of goodwill to cash account debited to X capital account to Y's capital account. X capital account was 11,250. Here it is 3750. Finally, he brought 1/4 share of its adjusted capital. So cash account debited to Z's capital account. It is 18,125. So closing cash is 5, 12, 53, 125. So write by balance carried down. Closing balance for balance sheet purpose is 53, 125. Then we will prepare the capital account of partners. capital accounts. On the capital account already over, that is balancing figure is given. We will prepare the reconstituted balance sheet of the firm. The firm is newly constituted after admission of Z. So for the reconstituted firm, we will prepare a balance sheet. So balance sheet of newly constituted firm. Newly constituted firm. That is, left hand side is liabilities, then amount, then assets, amount. Then on the liability side, one is capital, so we write capital accounts, that is XYZ. X capital was 46,875, Y's capital was 76. Wrong. That is 26,250 minus 625. So it is 25,625. 25,625. So 25,625. 25,625. Then Z is the amount is 18,125. So total is, that is 15, 8, 10, 12, 6, 2, then 6, 8, 9, 90,625. Then sundry creditor is 40,000. So liability side total is 130,625. Then we will do asset side, that is fixed assets. Under fixed assets, we will write first land and building. The value was 25,000 less reduction in value, that may be depreciation, that is 6250. So it is 18,750. Then furniture, it is 5,000 less depreciation 500, that is 4500. Then under current assets, cash we have already prepared. So closing balance is 53,125. That we have to write here 53,125. Then sundry debtor, it is 15,000 less 5% 750, that is 14,250. Then stock is here increased to 40,000. So total comes to 625. Then six, 7, 12, 13. So both side is 1,30,625. That means our balance sheet is correct. Thank you for watching this video. In the next video, we will prepare some problems relating to retirement and death of